Hey, it's Stuart. Most of us own property in our personal names. The thing is, though, you've got to get the ownership structure perfectly right when you buy the property because changing it later is very costly. So you only have one chance. And today I want to talk about some of the things that we consider when structuring property ownership in personal names. Now, previously I've spoken about we avoid family trusts typically just because often we can't normally get the full benefit of negative gearing, and if we do, we'll get some benefits really down the track. But also, family trusts tend to attract much higher rates of land tax. So we tend to avoid that from that perspective. I wrote or published an episode, 350 I think it was, episode 350, about buying property in a investment company, and that can be really attractive from a capital gains tax perspective, so you can certainly check that out. But today I want to talk about personal names, and if you've got a spouse or you're co-investing with someone, your options, you've got three options. You can own the property solely, jointly, or tenants in common. And I want to talk today about some of the things that we think about or some of the strategies that you can employ with those different ownership structures in your own situation. So let's start with sole ownership. I mean, as the name explains, only one person owns the property. That can be really beneficial if there's one person in the family unit that generates the highest taxable income and you want all the negative gearing benefits in their name. So if one spouse is working, earning $500,000, for instance, the other spouse is not working, of course, we want the negative gearing in the highest income earner's name. The other benefit or reason that we might use sole ownership is for land tax purposes. Now, in some states, or say actually many states, if you own property jointly, you are taxed as one taxpayer from a land tax perspective. Whereas if you own property solely, then each individual gets to benefit from their individual tax-free threshold, land tax-free threshold. So let's use New South Wales as an example. Land tax-free threshold around about $1 million. So if my wife and I own two properties, each with land value of about $1 million, we're not going to pay any land tax. That's a pretty good outcome. However, if we own those two properties jointly, our land tax bill is going to be about $15,000. And the reason for that is that if we own that property jointly, those two properties jointly, we're only going to get one land tax-free threshold, and we're taxed on any land holdings that exceed that. So that's where we'd use sole ownership. Let's talk about joint ownership. And joint ownership is probably how most people own their family home, for instance, where there's more than one person on the title of the property, but there's no discernible ownership percentage. So it's assumed that each person on title has an equal share of ownership. So again, if it's me and my wife on title of our property, which it is, our family home, it's assumed that we have a 50% share in that asset. So one of the benefits of joint ownership is that when one of the owners passes away, the ownership automatically transfers to any remaining or surviving joint owners. So for instance, if I pass away, our home automatically moves into my wife's name. It doesn't hit my estate. And that can be a really useful strategy. Well, it can make things a little bit easier, through administering an estate or when someone passes away. But also if someone has some concerns about their estate being challenged, often owning property jointly can be a good way to mitigate that risk, because actually the asset never hits the estate because it automatically transfers to the surviving joint tenant. The other benefit of owning property in joint names is that when we come to sell it, an investment property of course, and we've got to pay capital gains tax, we can spread that capital gains tax liability across two taxpayers, whereas if I own the property jointly, I've got to wear the full liability for that. For each additional taxpayer, that you can add to a property or that you can share that gain with, the maximum you'll ever save is around about $34,000. And that's because our tax system is a marginal rate system. So on the first 20,000, it's nil tax. On the between 20 and 45, it's 17% tax, and so on and so forth. And so if you look at, the tax saving on 190,000 versus the highest tax rate, 47%, the differential is about $34,000. So it's not a small amount of money, but if your capital gain is several millions of dollars, percentage saving is not that big a deal. In fact, then in that situation, we're better off to seek to maximise other outcomes like negative gearing or minimise land tax, those sorts of things. So joint ownership can be good from a capital gains tax perspective, but let's not overstate it. Okay, let's talk about the last ownership structure, which is the least common, I think, which is called tenants in common. Tenants in common differs from joint ownership because with tenants in common, we can ascribe a certain ownership percentage to each owner. So for example, my wife can own 80% and I own 20%, however you want to sort of set it up. The other benefit also compared to joint ownership is that the person's share that in a tenant in common structure goes into their estate. So that's the first situation where we use tenants in common is if I'm co-investing with a friend, for example, when I pass away, I don't want my share to automatically transfer to that friend necessarily. I want it to come into my estate. So I should own that property as tenants in common. So people co-investing with siblings or friends or just associates even, you would typically want to own the property tenants in common. The other benefit of a tenants in common structure is really from an asset protection or maybe an asset control perspective. So let me tell you a quick story. We had a client that when we first started dealing with this client many years ago, he'd just been through a marital separation, so he was single. He subsequently repartnered down the track, and he and his spouse at the time bought a house. Because the spouse really didn't have any sort of financial ability sort of make a contribution towards that property, we put the house solely in our client's name. Unfortunately, that relationship dissolved many years later, and when it came to selling the house, my client was able to control that process, appoint the right agents, make some good, smart, logical decisions. And thankfully, his ex-spouse at the time wasn't able to kind of frustrate that process, so he had full control. But when we have a situation where both spouses are our clients, we're giving advice to the family unit, normally what we would do is say, own most property at least 99.1. So 99% in the highest income earner's name and 1% in the lower income earner's name. And the reason for that is that at least both parties will then have control over that asset should there be a relationship breakdown, because no one can go and sell or make decisions without the other party because they're on title. And really marital separations or relationship breakdowns, probably our biggest asset protection risk really when we think about it statistically. And lastly, a tenants in common structure can be really useful where we have a lot of cash savings or we expect to accumulate a lot of cash savings, and there's a big disparity between spouses' income. So let me use a really simple example, and I'll just use some round numbers, ignoring costs. Let's say my client has $300,000 of savings and we want to go and buy a $1 million investment property. One spouse earns, say, $300,000, the other spouse doesn't work, no taxable income. What we would do in that situation is we would buy that property tenants in common. We would put 30% in the non-income earning spouse's name and 70% in the higher income earning spouse's name. We would still borrow 100%, but we would split it into two loans. We'd borrow $300,000 and $700,000. So both spouses are going to borrow for their share of the property. After settlement, however, we're going to put the $300,000 of cash in the offset account that's linked to the nil income earner's name, because that means that party will then get 30% of the income but have no interest expense, and they'll pay no tax on that income most likely. Whereas the higher income earner is essentially going to get 70% of the income from the property, but really 100% of the family's interest costs, because the net loans was always going to be $700,000, but that moves into the highest income earner's name, maximising negative gearing benefits. In fact, we might end up giving a little bit of gearing to the no income spouse's name. So maybe we could even go like 40-60 split. But essentially, if you've got some cash, or you're going to aggressively save cash, then a tenants in common structure can work really well. The idea is to maximise negative gearing, but also trying to minimise capital gains tax in the future by at least having some ownership share. And if you've got typically about a 30% ownership share, you really are going to minimise capital gains tax as much as possible. Now, just finally, what about buying your family home? Because obviously a lot of things I've spoken about today are really asset protection, capital gains tax, negative gearing, these sorts of things, which aren't really applicable, of course, to a family home. So there's two situations where we think carefully about family home ownership. The first one is that if we really thought our client was at risk of being sued, or we didn't want any assets in their personal name. Now, I've got to say, I think asset protection risks are often overstated. In nearly 25 years of giving advice, I've never come across a client that has suffered a significant loss or put their family home at risk. And I think it's something that's often talked about. It's something that scares all of us, but I'm not really sure that it's a big risk. There's a lot of things that you can do, business structures, insurances, all these sorts of things to mitigate that. But anyway, that's one thing. The other thing would be to think about, will it ever become an investment property? And I guess if it's your first property, chances are it probably will, or it could. But if it's your forever home, for instance, and you're in your 40s or 50s or 60s, well, maybe it's probably never going to become an investment property, but something to think about. And therefore you'd think about the ownership and how you set up the loans, and trying to maximise the gearing, the potential future gearing against that property. But the point is, really with this video, is that you only get one chance at it. Because if you mess up the ownership structure, to go back and change it, you're typically going to trigger capital gains tax and stamp duty. And so that can be really costly, and quite often, almost always, not worthwhile. So you really want to think then very carefully about, how are we going to own this property? Will we own it solely, jointly, or tenants in common? And if it's in tenants in common, what sort of split are we going to look at? And they're just some of the things that we think about when advising clients to own property in personal names. So I hope that's been useful. And of course, if you enjoy these videos, please subscribe to the channel, share it amongst family and friends. The more the merrier. And until next time, bye for now.